Okay, we're ready to begin the second half of a riveting day, and we appreciate the fact that David Drain, Senior Officer on Public Sector Retirement Systems from the Pew Charitable Trust, is joining us as the next testifier on our next panel. David is no stranger to Pennsylvania, certainly helped with much of the work that we've done over the last number of cycles. He is a principal investigator and methodologist for Pew's research on public sector retirement systems. And Pew has published Assessing the Risk of Fiscal Distress for Public Pensions, State Stress Test Analysis, which is very important. It's another one of the elements that this commission is charged with in stress testing, and we appreciate your testimony today and your continued help and support in our effort to be strong and effective public sector pension systems. Thank you, David.
Thank you, Chairman Tobash, Vice Chairman Torsella, and members of the Commission. Good afternoon, and thank you so much for this opportunity to share our research and our recommendations on stress testing for public pension plans. In my comments today, I'll be discussing the overall concepts of stress testing, the growing move towards including it as part of public pension plan disclosures, how states have used it to improve policy in the policy debate, and how Pennsylvania can incorporate stress testing going forward. My name is David Drain. I'm a senior researcher at Pew. My work has covered public sector retirement systems, the financing and sustainability of state and locally run pension and OPEB plans. The Pew Charitable Trusts is a nonprofit research and policy organization that is committed to informing the public and improving public policy with nonpartisan, rigorous, fact-based research. Pew supports over 40 projects in the field of government performance, covering a diverse set of issues ranging from public safety to the effectiveness of state tax incentives to the fiscal health of public pensions. Our retirement systems project produces 50 state research and provides technical assistance to policymakers in states and cities as in their efforts to make public sector retirement systems more sustainable and secure. We approach our work with a clear understanding that there's no one-size-fits-all solution and endeavor to provide objective, data-driven analysis tailored to the specific circumstances in each jurisdiction where we work. Stress testing is the concept of seeing how an adverse economic scenario will impact the affordability, sustainability, and solvency of public pension plans. This analysis entails performing long-term projections of key fiscal metrics, both using plan assumptions as well as alternative assumptions and scenarios to examine what happens to employer costs, plan funding levels, and ultimately plan solvency. Stress testing is a simulation technique used to determine the impact of downside economic scenarios on financial balance sheets. One of the most notable examples of stress testing comes from the Dodd-Frank Wall Street Reforms and Consumer Protection Act of 2010, passed in response to the Great Recession. For public pensions, stress testing involves taking existing actuarial projections and investment assumptions and sensitivity analyses as inputs and evaluates planned solvency and employer costs using various financial scenarios. Pew's recent stress testing report, which included Pennsylvania among the 10 states we analyzed, found that overall state pension plans were more vulnerable than ever to the next downturn, and that states with unaddressed pension challenges or insufficient funding policies face the real risk of insolvency. Apologies for kind of the small chart, particularly for the audience, but at the top left, we're looking at actuarial measures of risk. This is looking at pension debt as a share of GSP for the 50 states. And you can see that it's spiked after the Great Recession and hasn't really recovered in any meaningful way in the 9 years of recovery since. So states that are historically high levels of pension debt relative to GSP. At the top right is looking at the budgetary impacts. So we see that states have nearly doubled the share of own source revenue that's going to pay for public pension plans, crowding out other important public investments, even though by many actuarial standards, the contributions overall states are making are insufficient to the task of closing pension debt. At the bottom left, we're looking at the level of risk through investments being taken on. The declining gold line is showing what a safe investment return, as modeled by 30-year Treasury, could generate, while the top line is showing what pension plans as a whole are on average are assuming. And you can see that a growing gap has emerged since the early 90s between those two, and that gap needs to be bridged by risky investments. And then lastly, at the bottom right, cash flow. We see a growing gap between benefit payments going out and employer and employee contributions going in, once again, that needs to be filled in by investment performance, meaning that state pension plans are more dependent than ever on what their investments do. So while we identified states that had unaddressed pension issues and faced real risks of things like insolvency, we also found that states like Connecticut and Pennsylvania that had taken meaningful steps to turn around underfunded retirement systems were insulated against the worst risks, though employer costs could stay at current high levels for even longer than expected if investments underperform. And what we have here is projected employer contribution rates for Connecticut and Pennsylvania. Once again, two states that had made substantial changes both on funding policy and on plan design, and we see that in the expected scenario, contribution rates are going to rise to above 30%, or have risen to above 30% of pay, and are likely to stay there for up to 20 years. If things go as expected and things get paid off, we'd expect to see a decline in what employers would have to pay. And the risk of a low investment scenario here is really that those periods of high contribution rates get pushed out further. And not all of our news is finding distress. We look at states like Wisconsin that have maintained well-funded retirement systems that have been able to show stable costs and funding levels even under a stress test scenario. So Virginia is the state on the left. They really look like a typical pension fund. About the average in state funding levels, somewhat typical funding policies. And we see that over the next 20 years, employer contributions can end up taking from anywhere to 10% of payroll to 20% of payroll. A lot of volatility in what employers and thus taxpayers may end up needing to pay. And we see that Wisconsin, through a combination of maintaining a very well-funded retirement system and policies in place within their defined benefit to manage risk, has been able to keep relatively stable payments over time, and is projected to continue to do so. So this is an example of how policy can end up managing the risks from making a long-term promise in benefits and investing in risky assets to keep that promise, and also shows that in some cases what stress testing really shows is that your policies are sustainable. So the methodology we use for our report combined three inputs: actuarial projections, capital market assumptions, and projections of state revenue. An independent actuarial firm we work with developed the model we use for these projections. We then reached out to all of the pension plans covered in our analysis to share our preliminary results and to make sure we incorporated any additional data and context they had to offer, and that our expected numbers were matching their projections. The capital market assumptions were based on each plan's asset allocation and estimates for the expected return and distribution of returns for each asset class provided by our actuarial partner. And then projections of state revenue were estimated using projections of state GSP growth compiled by Moody's Analytics and the historical relationship in each state between own source revenue growth and GSP growth. What's important is that each of these inputs are things that states already have in systems in place to generate. Each state pension plan works with an outside actuary to generate actual projections. Each state plan should have assumptions regarding expected investment performance as well as risk that can generate scenarios for the stress test analysis. And states regularly produce estimates and projections of revenue growth. A state interested in adopting stress testing already has the tools necessary. It's also the case that using stress testing in states is not an academic exercise, and policymakers are already using this tool to either identify the need for reform or to compare between different policy options. Even for well-funded states like North Carolina and Wisconsin, stress testing can help policymakers anticipate what employer contributions will rise to in the event of a recession and allow for better budgetary planning. So Colorado's the example that we have up here. Their recent pension reforms were spurred by stress testing that found a more than 20% chance of insolvency under their existing policies. This allowed for the state to take proactive measures. Colorado PARA, the state's retirement system, offered a proposed set of reforms, followed by debate and deliberation in the legislature. They arrived at a final package that was signed by the governor on June 5th. The changes were built around the idea of shared sacrifice, with increases in taxpayer contributions, employee contributions, and cuts to the COLAs. And then to better avoid future pension crises, the law built in automatic stabilizers if the plan actuary calculates a deficiency, and formalized the requirement for ongoing stress testing, so they'll always have an early warning system. And specifically what we're showing up here is that the dashed line and the gold line at the bottom are what our projections, as well as Colorado's actuaries' projections, of what the fund would have done in a low return scenario before the reforms. As you can see, both projections show that the plan would have run out of money and hit insolvency. And then after the reforms were implemented, we did an analysis of what that looked like. And we see even in a low return scenario, they're able to turn funding levels around and see improvements, as well as having put measures in place to better track performance and the potential for fiscal distress going forward. Stress testing can also be used in considering between several different policy options. And the Pennsylvania Independent Fiscal Office is responsible for providing actuarial notes for legislation affecting the Commonwealth's pension plans. What they included, their reports that they used in deliberations that led to Act 5 were measures not just of cost of different options, but of risk. To decide between different options, policymakers need to understand the impact on cost, risk, and retirement security. And by working with plan actuaries to get analyses using alternative return assumptions, the IFO is able to incorporate stress testing into their legislative actuarial notes and provided a more complete picture to Pennsylvania lawmakers in their deliberations. Stress testing analysis can also avoid policy changes that would add risk or unexpected cost to an otherwise healthy pension system. Pennsylvania is experienced with this. In 2000, the state's pension plans were reporting a surplus, but subsequent decisions to provide the largest unfunded benefit increase in any state and to artificially lower contributions until 2010 contributed to a massive swing from surplus to funding gap. Policymakers and the public had more complete information about the cost of these changes and the risk of future downturns that would erase some of the investment gains from the late 90s. Perhaps those decisions could have been avoided, leaving Pennsylvania in a much stronger position today. Pennsylvania adopts stress testing. It will be part of a larger trend across states and would bring its reporting in better alignment with actuarial best practices. Over the past decade, we've seen a broad review of actuarial standards and public sector financial reporting practices that have led to the conclusion that state and local plans need to understand and disclose risk. This has been reflected in new GASB rules that require liability reporting using alternative return assumptions, the Society of Actuaries Blue Ribbon Panel Report, which I think will be discussed in detail later, and new standards of practice by the Actuarial Standards Board. And we're seeing is that state policy is catching up quickly. Colorado, Connecticut, Hawaii, Virginia, and New Jersey have all enshrined stress testing in statute in the last 2 years. Pennsylvania already has the pieces ready to conduct stress testing. The actuaries from CSRS and PSRS have produced actual projections using both plan assumptions and alternative return assumptions. CSRS and PSRS also regularly assess their investment portfolios, understanding both the expected return as well as the distribution of possibilities, and report measures of investment risk. And the IFO could extend existing revenue projections further out over longer time horizons. And while much of the underlying and data analysis is already being produced in Pennsylvania, putting it all together in a public disclosure would better allow policymakers, stakeholders, and the public to assess the long-term fiscal health of the Commonwealth's pension systems and the budgetary impact of funding promised retirement benefits. As we noted, including stress testing analysis as part of regular pension reporting can give early warning if problems arise, help improve budgetary planning, understanding what the employer contribution rate might rise to if you're a state budget officer or a school board, allow better assessment of proposed pension changes, and avoid costly mistakes. I would like to thank the committee for this opportunity to share our analysis and recommendations. Our research points to stress testing as an important part of public pension disclosures, a finding supported by growing awareness among actuarial groups, researchers, and policymakers of the usefulness of this analysis. Pennsylvania has the opportunity to be among the forefront in adopting best practices in this area. With that, I'm excited to hear from the remarks of my co-presenter, and after that, looking forward to questions and a robust discussion.
Dr. Spat, if it's okay, I will introduce you. Dr. Chester Spat is a distinguished visiting professor of finance at the MIT Sloan School and distinguished senior fellow at their Golub Center. He's on leave at this point in time from Carnegie Mellon. He, at one time, served as the chief economist of the Securities and Exchange Commission from July 2004 to July 2007. He has earned a PhD in economics from the University of Pennsylvania. Thank you very much, as well as an undergraduate degree from Princeton University. Thank you so much, Doctor, for being here today and sharing your expertise and your advanced research on stress testing.
Thank you, Chairman Tobash, and thank you to the members of the commission for hearing me. I'm pleased and honored to have the opportunity to present my views to the commission at today's hearing. I think in the interest. The first page of my statement lays out my background, but Chairman Tobash did such a nice job of summarizing. I think we'll save the time to focus on the substance of my remarks. So let me begin by talking about what is financial market risk. I think it's helpful to clarify these risks and to divide them into two broad categories: systematic risk or aggregate risk, which, because of the commonality of risk across assets, cannot be diversified away by simply forming portfolios. And the second category of risk, idiosyncratic risk, which is largely eliminated by forming a diversified portfolio. Risk premium is earned in the capital markets by bearing systematic risk, but not by bearing idiosyncratic risk, since the idiosyncratic risk can simply be eliminated in forming portfolios. To shed more light on the nature of risk, I'll note that payoffs are especially valuable in weak states of the economy, for example, after low market returns. For example, risk is not really simply about the variability of returns in individual assets, such as when the returns of assets might be 30% one year and 0% in another year. But I think people really started to understand, I think, more deeply the nature of risk after the financial market crisis. There we had a situation where you had this 40% decline in asset values, and for a while it looked like this was a permanent decline in values. And it's sort of the permanence of the decline in values that I think really kind of points to some of the importance and fundamental nature of risk, because one's liabilities do not go away in the presence of such a decline. And indeed, we just heard about the substantial underfunding that arose for a variety of reasons, partially increases in benefits, but I think also partially because of the decline in asset values. We heard about the substantial decline in funding that arose shortly after the financial crisis. Pension recipients, to be clear, anticipate that their pensions are going to be paid in all states of the economy, and that the plan sponsor will not default on these payments. I think that's a very important point to understand, because to the extent that that perspective is correct, that the plan sponsor doesn't plan to default on the payments, these actuarial liabilities are riskless, and according to financial theory, these obligations must therefore be discounted at risk-free rates, not at equity-like rates that have sometimes been suggested by accounting practitioners, such as the Government Accounting Standards Board. We would then measure the underfunding as the liabilities discounted at risk-free rates less the current value of the plan assets. So this, of course, raises an important question: is it reasonable then to invest in equity? Well, one important rationale for equity investment in pension plans is if it's valuable to hedge pension risks that are correlated with the economy. So, for example, if the collective pension obligation of the plan is correlated with market returns, then you might say, well, how could that come about? Well, one reason is if, as the market does well, the state hires more employees, and if the market does badly, the state has fewer employees. Or alternatively, if somehow the pension benefits were sort of linked to the market performance. So in that case, certainly it would be appropriate to own equity. But I think more. However, it's important to keep in mind that the liabilities of the plan, they're going to need to be paid and this raises an important issue: who bears the risk associated with inadequate market returns, such as, let's say, in the case of the 2008? Is it the workers? Is it the taxpayers? Which generations? These are kind of important questions. These are questions nobody thinks about. And in particular, it's really related to the investment issue. And, at first principles really kind of implicitly suggest that plans need to be fully funded and they should be invested risklessly. At the same time, I'll come back to the investment point in a moment. This seems to me to raise a question: is it ethical for politicians and union leaders to negotiate underfunded pension plans without being transparent and without resolving the risk-sharing issue? So that's a different aspect of transparency. But the underfunding, in a way, is an attempt to hide from both the taxpayers and the workers the underfunding, to hide the fact that the benefit is not fully funded. There's this collective bargain, but who's assuming the risk? It's not the people who are negotiating, either side, by the way. Neither the political leaders nor the union leaders who are assuming the risk. They're not assuming it personally. They're having either the taxpayers or the workers assume it. And so, to some extent, this is not so clear cut who's assuming it. It does seem to me that the commission, the treasurer, and the trustees could play an important role in the transparency of this issue. Now, I want to be clear on the broad question of whether pensions should bear equity risk. Despite what I've said, I'm not a hawk who asserts absolutely not there should be no equity risk. I'm not suggesting that, but it does seem to me that one needs to think kind of more deeply than I think than most states have. This is not a particular criticism of Pennsylvania. This is a broad national phenomenon involving state and local government pension plans as well. Indeed, I view financial theory as providing at least a little bit of scope for holding equity. Indeed, a small amount of equity can be held without moving the pension plan away from risk neutrality. If the investors hold little risk, they're locally risk neutral, and are able to earn a risk premium without taking on material risk. More fundamentally, to the extent that the economy has natural risks, these should be borne and spread out among capital in the whole economy. Indeed, this is the essence of equilibrium risk sharing within the economy as a whole. The formal equilibrium analysis, under which demand equals supply, in fact suggests that baseline relative demand should reflect relative supplies, and this leads to a form of what's called a capital asset pricing model, in which the demand for an efficient portfolio that's fully diversified along the risk-free frontier should equal the supplies of the risky assets, or equal, in effect, the tangency portfolio in the traditional theory equals the market portfolio. That's basically a statement of supply equal demand. Another reason that both private but I think it's also important to keep in mind that another reason that private and public plans sometimes desire to hold equity risk is the possibility that poor performance would create an opportunity to bargain away the benefits due to the threat implied by limited funding. And to just kind of make this idea more tangible, consider cases like Detroit and Puerto Rico. If ultimately the resources aren't there, there may need to be some degree of renegotiation. So indeed, this is kind of another rationale for holding equity risk. Now, this may seem kind of a little bit facetious on my part, but in a way, it's not. Formally, the private pension plans have had a bankruptcy or termination option. Now, the states don't have that. At least the formal bankruptcy option. Certainly, the states don't have under current law. But the idea of sort of walking away, this is sort of makes the case for owning equity investment. And if the goal is not to walk away, keep in mind that the exposures are riskless, and that should perhaps reflect what the asset allocation is. This impact is strongest, by the way, when the plan is most underfunded. And indeed, I discussed this in more detail in a speech I gave at Georgetown when I was SEC chief economist, and specifically in a private pension plan setting. Now, the broader point is that this potentially undercuts this help. On the one hand, it sort of helps Pennsylvania bargain, but to the extent if the union leadership is foresighted, they recognize this, which means that they potentially may want to actually bargain about what the asset allocation is. Although I don't think we've seen evidence of that to date. So let me turn to then a kind of a number of more specific and pragmatic issues in the context of the plan. So first, the issue of leverage. I understand that there is certainly a significant amount of leverage in the Pennsylvania plan. Leverage leads to greater systematic risk and potential for further underfunding. And again, this leaves open the question: who bears the risk? The workers, or the workers and beneficiaries, or the taxpayers? Leverage raises concerns about excess risk-taking. Unlike the more basic risk sharing, equilibrium considerations don't support the generic use of leverage, except perhaps based on this argument that I've offered as a way to bargain away for Pennsylvania to try to bargain away some of the future benefits by taking on a lot of risk, and if things go bad, sticking it to the workers. Well, I don't know that the state necessarily wants to be in that kind of position, but in a way, the leverage strategy seems to me that's kind of in a way what it's sort of about. And by the way, an additional confounding issue with leverage is that the cost of management increases artificially. This morning, of course, I think we heard some very interesting and I think very thoughtful remarks based upon a paper by a fellow academic at Oxford, a very interesting paper. So I don't want to say too much about illiquidity, but I'll make just a few observations on this front. Illiquid assets, of course, have liquidity costs, but these in principle may only be a limited disadvantage in a pension plan context because the pension plan doesn't need that much liquidity on a year-to-year basis. Still, such positions are challenging to adjust and costly to manage, and relatively unsophisticated investors, including state pension plans, I think don't have a comparative advantage in owning such assets. And I think this morning we heard in a fair amount of detail why in fact something like a state pension plan doesn't have such a comparative advantage in owning those assets in terms of being able to kind of really drill down through some of the lack of transparency that we heard about. The lack of frequent asset marking or valuation and the lack of market liquidity certainly, in my mind, even absent that evidence that we heard this morning, suggests the needs for viewing projected and historic returns skeptically. For example, historic and projected returns may be overstated, and indeed, it's clear that riskiness is understated. Why is that? Because the valuations in these private equity programs and various non-marketed programs tend to be smoothed. If you look at the valuations in the non-public assets, the valuations seem much smoother. Let's say on a quarter-to-quarter basis. Now, the advocates of these plans, they would say, "Oh, well, that's because we're investing in less risky stuff." No, that's not the reason. The reason is because they don't have clean valuations. So they tend to look to the past in part. They place weight on the past. They tend to produce smoother numbers. So the numbers are artificially smooth, but what you get from historic data is really understating the fundamental risk. And indeed, what does all this suggest? Well, if you suspect that the past returns are overstated, and if you suspect that the riskiness is being understated, both of these effects suggest that that you run then a portfolio model on this, that's going to produce excessive risk holdings of illiquid assets. And I would submit that this is consistent with the observation that the holdings of illiquid assets in some portfolios, including Pennsylvania's, are vastly disproportionate to the holdings in the economy as a whole. Well, I would argue, I sort of puzzled a little bit about this. How come the holdings here are like 40 or 50%, and in the economy as a whole, it's relatively small? And then I realized, oh yeah, there's these measurement problems, and so consultants come in and they claim that if we use some mean variance analysis, you should hold very 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 high numbers, and it gives you a great risk return trade-off. I would submit no. You're not measuring things. It couldn't be then. You're measuring things properly because the equilibrium. And that's part of the reason I went through the equilibrium argument earlier. Because if you do a proper analysis, it should be that at least for a typical investor, if these assets are only are in limited amounts in the economy, their role should be modest because they only have a slight weight in the capital market. So one additional point that I want to highlight is that rents are being earned by asset managers with scarce skills. And my late colleague Rick Green and Jonathan Burke at Stanford, in fact, have a very important paper about this. The rents are being earned by the asset managers, and quite naturally, who bring scarce skills to the table. But you wouldn't expect that the rents from those scarce skills would necessarily flow through to the investors. Why? Because, first of all, it's a little bit hard to identify which managers are truly superior. And furthermore, if the managers have really scarce skills, they're going to be able to earn the rents because there's going to be a lot of competition for their services, and they're going to be the ones who are going to be able to earn really high fees. Superior skill is hard to identify, especially given the cross-sectional dispersion of returns and issues of limited statistical power. Costs are extremely important to consider in evaluating managers. Indeed, when I was SEC chief economist, I emphasized this to the papers. I presented by coincidence in Harrisburg to the papers group about the value and importance of index investing. So one final point that I also want to note is that just as private pensions have pretty well moved away from defined benefit investing, and I think there's an important insight in that. They've exited largely from, at least going forward. They can't eliminate the past plans, but many companies have gotten rid of their defined benefit pension plans. They've substituted, they provided more extensive 401k benefits. They've gone to cash balance plans and the like. And why is this? I submit this is because of the various incentive and moral hazard problems. And in my remarks, I kind of alluded to some of these. And I believe that public plans would do well to do so as well. Now, this may not be directly within the purview of your commission, I recognize, but I do think the incentive problems are even more severe in the public sector with the public plans, because both sides of here, at least in the private case, to the extent that the negotiators, the managers, own equity in the business, they're gonna kind of get the long-term benefits. The politicians who make the final decisions, their focus is within their anticipated life in public position, and if many of these issues don't come home to roost for decades, I think this is why we've kind of gotten into some of the problems we have. Anyway, let me stop at this point, but I look forward to the opportunity to answer questions on my remarks, and look forward to hearing your questions as well on my co-panelists' remarks.
David, Dr. Spath, thank you so much. My head is spinning, Doctor. I don't know how well I do in your class. I'm glad that I'm asking you the questions.
I'm sure you do fine.
You're not asking me. So it's tremendously interesting. I guess I have a question for the both of you, and you've done a tremendous amount of research, and you've got a perspective that comes from so many different angles. It's really appreciated. Tell me about our historic vulnerability right now of our pension funds and really the economy that is invested so heavily in what you characterize as a differing investment portfolio than the rest of much of the economy within these funds with illiquid assets. David, what do you think about our vulnerability right now?
Well, and I think when we're going to talk about this, we're using our in the big 50-state picture. I think states like Pennsylvania that really have taken some meaningful steps, really are, even if the funding levels are low, are better positioned for the future than states that don't use actual funding policies, that haven't, managed their risks, and things of that nature. When we look big picture, one, we've seen really in the last two recessions very limited recovery after the recession in planned funding levels. So as a share of GDP, as a share of GSP, pension debt's been flat after the Great Recession. It was, similar after 2001 and the dot-com crash. That has a number of drivers. One of them is simply contribution policies. The policy choice to underfund in many states, particularly in good times, when you have the ability to try to make up ground, has led to this ratchet effect of going up. The second is, if you look back over decades, we've seen this tremendous shift from safe investments to risky investments, and then from simple risky investments like equities to more complicated investments, hedge funds and private equity and real estate, the alternative investments. I think there's a lot of reasons to think that there might be some gains from taking on that risk. You've got these long-lasting entities that have predictable cash flows. They can take on, the argument is that they can take on some level of risk. What's certainly the case is that if you have more complexity and more volatility, you need to understand that and manage that. Some of that goes into the work we've done on investment disclosures, but also if you have a bond portfolio and you've got a very simple investment mix, then simply saying, well, this is what we think our expected returns are going to be, let's anticipate that going further may be sufficient. If you know that you're invested in the stock market and you know that your returns are going to largely follow the broader economy, and you know that there's a business cycle, you need to have some analysis, available to policymakers, available to stakeholders, available to the public, that tells you what that means in terms of state budgets. So that's what we're seeing in terms of stress testing. And I guess the last and final piece is on cash flow. We know that as baby boomers get older, as we have this demographic shift of fewer actives and more retirees, every boost or every dip in your investment performance is going to have an outsized impact on your pension plan's fiscal health, and then ultimately on the taxpayers. Simply because the retiree pool is going to be relatively large compared to the active pool, and so kind of all of those pieces are why we see more broadly on a 50-state level more vulnerability than we have any time in the past.
So relative vulnerability, and I understand your discussion on who bears the risk, and obviously we're defined benefit, and we've taken some measures to try and offload some of that risk to the participants, to the taxpayer down the road. But where do you think position right now in the state of Pennsylvania or else nationally?
So I don't have a strong view about that, other than that I don't think Pennsylvania is near the worst off states. The states that people talk about the most are states like Illinois, New Jersey, California. These are the states. So there are papers actually that do some of the cross-state comparisons, and perhaps after the hearing I'll try to review that in more detail. There's a terrific researcher at Stanford named Josh Rao who's done a series of papers about the underfunding issues in state pension plans, and has actually in part offered cross-state comparisons. Now that work may be somewhat dated. That work was done a number of years ago, so it may be kind of dated relative to the current market conditions. It is of concern, I think, that there's been relatively little recovery after the Great Recession, and this may be related in part to the funding, maybe related to the ongoing funding issues. A lot of private portfolios have done extremely well because it at least relative to the bottom, or even relative to prior to the Great Recession, the overall returns have actually been okay. Have been okay. I mean, if you look, for example, at where the market was in 2007 before the Great Recession, the Dow, for example, was at 14,000. Now it's at 25,000. That doesn't take into account the ongoing dividend. So you've had asset values basically double or even a little bit more. Those are perhaps not extraordinary. Well, that's what returns have been, because in part you had the initial problems. You would expect that there would be significant. You would have expected perhaps that there would be significant enhancement in the situation. I worry a lot about the issue of cost, and so one of the main concerns that I have is that over time there's been evolution to holding more and more illiquid investments. And I've never really fully understood, in other contexts too involving institutional investing, I've never really understood the case for not investing mostly through the broad capital markets. And indeed, within Pennsylvania, and I know we don't have a Buy Pennsylvania program per se, but perhaps but I would argue probably the leading low-cost public investor is located in Valley Forge, Pennsylvania, namely Vanguard, and they offer for a lot of their products. They offer even to people like me. They'll charge me like 4 basis. They charge me 0.04% to give me broad equity market exposure. And obviously those are lower cost opportunity. In fact, lower cost because they have institutional fees as well. So I worry a lot about the cost issue.
Great, and then I'll move on to another. I just have one thing really quickly because you've kind of bridged over here back to the cost. So, as in your former role of the chairman of the SEC,
Chief economist.
Chief economist of the SEC. What do you think about this idea of transparency and a state-by-state model, or even the SEC getting involved in a national model for transparency?
Well, I think more transparency. So I found very interesting the prior panel. I think more transparency would be a good thing. I thought one of the important issues that was raised in the prior panel is that it's likely that the industry would be quite naturally resistive of different disclosures for each specific state, because that's imposing a big cost burden on them that ultimately the investors, of course, would bear. So I thought the idea of trying to have relatively uniformity in the disclosures make sense, and it could be through a private group, such as the group that we heard from at the start of the prior panel. Potentially, it could be through the SEC. Now, the SEC is sort of tricky because they don't tend to want to be they don't either want to be involved or feel that they have jurisdiction so directly over lower level government or also federal government too, investments per se. But anyway, I do think uniformity could be a very good thing. And indeed, if disclosure requirements were adopted one-off, then the point that was raised that the pension fund could just reject kind of individual players. That sort of makes a lot of sense. I do think it's important that the disclosures be appropriately framed, that they not focus, for example, upon because one of the objections sometimes about disclosures is that the disclosures are forcing the revelation of really confidential information about investments, and I think one has to be careful about that.
Thank you very much, Mr. Vice Chairman.
Thank you both for very interesting testimony. I do think, Dr. Spratt, the question of the plan design is beyond the scope of the commission and one that would have some real disagreements on this panel, although I think, ironically, some of the things we can agree on. I mean, as somebody who believes in a defined benefit plan, in part because of the difference in states and cities, in part because of the efficiencies. Ironically, I think if some of the things we've been talking about, like stress testing, had existed 10 years ago, we might have avoided, for example, the state's fairly dramatic underfunding of the plan and be in a different position today. But you raise a lot of fascinating issues around kind of lots of things, liquidity and cost. But the one I want to focus on is this issue of should a stress test impact how we look at our liquidity profile in the fund? I mean, should that be a component of what a thoughtful fund uses to look at that? I wonder if you could both talk about that, and then in particular for you, Dr. Spratt, if you see any parallels between this and the stress testing that you helped implement, the regime for banks, be useful to hear that. And from your perspective, Mr. Train, who is the intended audience for a stress test? Is it trustees or is it all of us here in the Commonwealth? So one question for you both, and then two particulars. Thanks.
I think the stress test. I think the stress testing is very. I mean, I think doing the stress testing. Doing the stress testing is very important. Is obviously is potentially important. It seems to me that the first order impacts of a stress test would be to inform. It would be to inform the trustees, of course. It would also be to inform the taxpayers and the workers and beneficiaries. And this kind of relates. This really relates closely to kind of the way I sort of frame the transparency issues. And why would it help inform them? Because they would understand then that the bargain that their respective leaders were negotiating was kind of incomplete, and that sometimes there's a problem on one side of the ledger or the other, and that would seem to be very important. Now, do I also see this as feeding into the asset allocation? Why do I see it as relevant for the trustees, for example? Well, because to some degree you would think it would feed into the asset, and I think this is sort of the. I don't want to speak for my colleague, but I think this is actually part of the point of the underlying advocacy of stress tests, that it would feed into people understanding that in the bad states of the economy, that there's this cost and people are left holding the bag that don't realize it. A lot of state pension plans are projecting these days future rates of return of, let's say, 7.5% or some numbers like that, as if you can earn that risklessly, and without taking into account the implicit risk associated with that exposure. And those risks are kind of what a stress test would kind of pull pull out. Now on the question about how does this relate to the stress tests of the Federal Reserve? So the Federal Reserve stress tests were about looking at what would be the situation confronting our largest financial institutions in the event of adverse or really bad returns in the bad states of the economy. And in a sense, that's what the stress test would be doing here as well. What would be the situation involving, let's say, Pennsylvania's pension plan in the bad states of the economy? For that matter, what would be the situation involving New York's pension plan, or et cetera? Although that would obviously be outside the jurisdiction of Pennsylvania, but you can sort of think of it at sort of a national level. Just as the Federal Reserve, it's stress testing the various banks. Well, there's really no analogous federal regulator to kind of. And I'm sure the federal government wouldn't want to get involved in doing this, because it would probably then take on yet another kind of obligation. Because in a way, if it started to stress test the individual state pension plans, there might be some kind of implicit guarantee that it surely wouldn't want to go down that path. But in a way, I see it as very parallel.
And a couple pieces to a couple questions. First, on the liquidity question, I think we've thought about this issue most in terms of deeply distressed public plans that have liquid assets and are wrestling with, how much can you keep when your asset levels are, twice your annual benefit payments. And in that case, you really have to ask the question not only if things go as expected, can we have our liquid asset base given these things, but also what happens if things go worse than expected. As you move further up the well-funded levels, at least from that perspective, it becomes less of an immediate concern. On who's the audience, I think it's a combination of policymakers. Obviously, policymakers in Pennsylvania and other states need to make the best decisions possible. So analysis, that gives you an early warning if something, if your policies are not sustainable. Something that gives you better tools to compare different policy options if you have them presented to you. We'd also say, obviously, the public and stakeholders, not only taxpayers, but public employees and retirees need to know about the health of their system. And then lastly, I think it's also useful to think about this as a budgeting tool. So, we know that there's going to be a recession. Mark Zandi put his hat in the ring on June 20th, 2020. Who knows exactly when it's going to happen? You can ask him, but we know it's going to happen, and what does that mean for the state of Pennsylvania's budget? You're going to have losses. It's going to feed into the actual determined employer contribution. Similarly, school districts will have that same thing. We, as part of the discussions and debate in Pennsylvania, about the pension challenges, we had the opportunity to talk with the School Board Association, and we had our various presentations and slide decks showing kind of how the contribution rates ticked up over time and was projected to continue under the collared rates under Act 120. The degree to which the prior increase in the employer contribution rate and then the future increases were going to come as a surprise to many school districts, I think talks about the importance of giving people more lead time in budgetary planning.
David, let me ask you, are you familiar with the stress testing that the systems are currently doing?
In Pennsylvania, we're familiar with, so fun, the stress testing and the asset liability studies, is kind of.
Yeah, I don't want to ask the other. I guess that there has to be some ideal as to how much what stress testing we should be doing, and if we're doing it now, and what should we do, or what should the systems do, so they're doing enough stress testing at enough intervals, so they're doing it often enough. What parameters should they be using, and what parameters are they currently using, and what changes would be recommended to the systems so that the stress testing would give the information and get the information out, at least to the boards, but possibly to the boards and the public, because the one thing that I think that you were talking about is, you've got 500 school districts in in Pennsylvania. Got 500 in Philadelphia, too. You have 500 school districts in Pennsylvania, and they're all going to be affected if we start to run into some significant problems. So question is, how often are we doing enough? What parameters are the parameters we're using wide enough? That's a lot of questions.
So on the how often, I think, to us, this is something that can be easily incorporated into the annual actuarial evaluation. That it's the same projections that they're already doing, but then adding in other return scenarios to see what those same projections look like if you were returns were 1 percentage point or 2 percentage points lower. Second, I think having done those projections, we think there's real value in making part of the public disclosures simply the baseline projections of what you think will happen. I think the number of times we found either policymakers or stakeholders learn something valuable from just simply 20-year projections of what's going to happen if everything hits their target tells us that that's a valuable thing to include. And then, kind of lastly on the kind of what's the kind of core standards, then doing that same thing if returns were just 5% each and every year, if they had a specific asset shock, kind of as envisioned in Dodd-Frank. Then on top of that, certainly, and this is something that many plans are doing on their own internally, you can add on stochastic analysis, you can add on other scenarios that seem relevant. You can add in questions about policymaker decision making, particularly around the contribution rate. We've seen places where the concept of stress testing what happens if the state makes only 75% of the ADEC as part of the what's included. But annual projections of core measures under baseline and alternative return scenarios is kind of the core concept as we think about it.
Okay, this is not my strong area, stress testing, believe me. But I'm not sure who does the stress testing right now for the systems. And I don't know whether they do it internally or consultant, but it would seem to me that an independent actuarial company firm should be doing the stress testing, or am I just way off on that?
So it can be done within the plan's actuaries. I think one strength that we see broadly in Pennsylvania and how they've handled, and actually I think something that other states could look at as a potential model is there's an actuary hired by each of the two plans, and then the IFO has a separate actuarial contract with a separate actuary that then takes in those valuations, but gives a kind of an extra eye with expertise. And kind of the broader concept of plan actuaries, and then having kind of the state having an ongoing relationship with a separate actuary to make sure that the state is getting the information it needs, seems to be a practice that, as far as we can tell, has worked well in Pennsylvania and could work well in other jurisdictions.
Well, it certainly gives me some peace. I'll be able to sleep tonight.
Steve.
Thank you. Just a quick comment. Having been on the PSERS board, I'm familiar with their annual asset allocation meeting, which I think we've all been invited to on the 10th. It's being held at the Pennsylvania School Boards Association. And I believe they're, while the asset allocation is the focal point, I believe they're also discussing the stress testing they do. So if any of the commissioners would want to see firsthand what one of the major pension funds in the state and how they handle the stress testing internally, it'd be an excellent opportunity.
And one of the things that we did in preparing our report, which we certainly appreciated because this is incredibly useful for us, is have a call with PCERS and with their actuary to, because the purpose of everything we do is to try to say, is to start off by matching the plan actuary projections as kind of the baseline, and then asking, well, what happens if different things change? And so working with the plan actuaries to make sure that we were, taking the same inputs and understanding it equivalently was critical to our analysis.
Excellent. Thank you very much. Just one real quick last 2 words: discount rate. You mentioned 7.5. We're at 7.25 for both systems right now. How does that affect, you think, our ability to manage the debt that we have currently and forecasted through the future?
So piece one is the higher your discount. I think the way we think about it, which is maybe not the most intuitive way, is that if you overshoot in your discount rate or undershoot on your discount rate, it changes just when you're going to pay. You pay the bill, right? You owe pension checks to workers and retirees. And so if you set it too high, and you undershoot in early years, that just means your bill later gets bigger. Kind of the other piece of it, and something that I think we kind of thought we're going to see coming in our stress testing analysis, but really was emphasized by it. So if you remember back to that slide we shared on Virginia and Wisconsin, and we had 3 sets of bars for each state, and each of those is looking at a bunch of different runs, simulated investment scenarios, all of which equaled, in one case 7%, the expected rate of return, another 6.4%, kind of one of the scenarios we looked at, and then the other kind of a particularly low return scenario. In other words, in each of these scenarios, the long-term investment was the same, and yet the amount that employers had to pay varied tremendously. And you can see this in the kind of lived experience of, over the last 30 years, public pension plans have more or less hit their investment targets, and yet we see $1.4 trillion in unfunded liabilities, and we see severe strains in many states. And so it doesn't just matter what your long-term investment is, it matters when good returns and bad returns arrive. And I think that has ended up being an underappreciated aspect of the risks for public pensions.
Yeah, and I would emphasize that the amount of underfunding that people talk about, because it's usually based upon these 7% type rates, is vastly understated, and I think that's very important. At a minimum, I would recommend that if one can't do away with that, perhaps because of the GASB treatment or for other political reasons, that one provide a second disclosure that would be, whether it be whether it use the Treasury prices, or maybe some spread, maybe single A bond prices or something like that to discount the cash flows. And if you're using a 3 or 3.5% interest rate on the liabilities, because those, as I commented earlier, those liabilities are riskless, the amount of underfunding is going to be obviously dramatically higher. And I do think that both the public and I think the workers and beneficiaries, they should know that. They should know that. And I think this is I think potentially an important dimension, yet another important dimension of transparency, which has obviously been an important theme today.
Thank you again so much for your testimony, and the commission may be back in touch. We appreciate your consultation.
Happy to provide any assistance I can to the commission.
Thank you.
Thank you.
This is our final panel.
PowerPoint. Somebody loaded them. Yeah. And then this is you?
Yep.
There we go.
All right.
And this, that's right. Yeah, I'll do it. Don't worry.
Okay, great. I will make, again, a brief introduction. We appreciate our last panel here. I know it's a long day with just a lot of information, and I think our first testifier is Ken, and then I see it listed as Kenneth, so I'll say Kenneth Ken Kent, if that's all right. Consulting actuary from Chiron, and we appreciate the work that Chiron has done for the Commonwealth in the past. Consulting actuary has served or is currently serving as the Vice President of Pensions for the American Academy of Actuaries, President of the Conference of Consulting Actuaries, and Chair of the Joint Committee on the Code of Professional Conduct, an advocate for rigorous stress testing in public pension management. Thank you very much for your presence today.
Thank you, Mr. Chairman. Thank you, Commission, for inviting us to participate in this panel. I do have over 40 years of experience, and I have a fair amount of experience with the Commonwealth. To be clear, I think you call it PMERS. I was the actuary on PMRS. I'm also the actuary for the city of Philadelphia. We've also done work for IFO, and in the past panel where there was discussion with regard to stress testing, the last go-around, we provided them with stress testing of some of the legislative alternatives for their purposes, and before them, I worked with PERC. I'm going to use not a dialogue, but a handout. I'm going to read from it. I'm less comfortable doing that than just presenting, but I want to try to stay on track. Since joining Chiron in 2005, stress testing has been an integral part of my consulting for every one of our clients, and it is included in every actuarial valuation report. Today, I'm going to present some background on why stress testing has come to the fore, define what it is, show how it works, and discuss its importance, and demonstrate why it is, in our opinion, an essential tool for decision-making. Pension systems are constantly in the news, and mostly in terms of those with severe funding challenges. Gradually, there are those emerging with success stories, but news is made through crisis over successes. We continue to see funds have reached the tipping point, particularly with large multi-employer plans and some public plans that seem to be up against a wall. The actuarial community and think tanks have made note with a consensus and theme that while not a solution, stress testing is an important aspect of measuring the risks and addressing them to mitigate the trends of systems and correcting them. We have always felt that while the valuation process is necessary to benchmark the current progress of your valuation system and determining an actuarially determined contribution rate in meeting sound funding policy, to actuaries' financial stability for retirement systems for a large part has been the reporting representing a historic view of funded status. When the valuation reports come out, the numbers are already history. The markets may have well moved. Unless the report provides projections of future funded status, you have no certification of the effectiveness of the funding policy. You don't know if, on a projected basis, it's going to improve the status and how quickly it'll do so. And without an illustration of the alternative results besides those that are used as the actuary's best estimate of assumptions, you've not met or represented the risks of the system by disclosures in evaluation report. One thing that actuaries are easily willing to tell you is that you're never going to absolutely meet our assumptions from year to year. We hope you get close, but there's volatility. So the first piece in a valuation report projection is a deterministic projection where we show where things are going to go if you meet our assumptions. The second piece is stress testing. A retirement plan is a financial system similar to a bank or an insurance company. The other systems are obligated to monitor their solvency through regulations to demonstrate their their continuous viability and behavior under alternative economic environments to demonstrate their ability to hold up. Anyone following the yearly concerns with Social Security are aware that in their reports, they show 3 alternative assumption sets: their best estimate, an optimistic, and a pessimistic. And interestingly enough, unlike many pension funds, Social Security's greatest concern on volatility is demographic, because their investments are defined already as U.S. Treasury notes. So their stress testing is what happens if the population doesn't change as expected and doesn't grow, so that you have new members coming into paying into the system to cover the obligations for those who are receiving payouts. To incorporate stress testing into your decision process, it's important to know its limitations. Stress testing is not a solution, but a forward-looking measurement of potential outcomes. It's not a decision, but a valuable form of information by which you can compare the impact of decisions on future outcomes. It is not a risk, but a visualization of the current and future risk and ability to compare the implications of decisions on those risks. So stress testing measures the risk of a financial system's ability to meet future obligations. For pensions, when we model them, things usually look like they will work out, because when contributions have to increase to respond to financial conditions, the funded status always improves. This does not necessarily work where public plans are limited by a maximum legislated contribution rate, as was the case in the past for Colorado, and why, as you saw, Colorado had a potential for insolvency. But what is not accurate is the assumption that the resources are available or anticipated to be available to achieve the funding. And we call that sustainability, or unsustainability when the contributions get to a level that a public entity can no longer afford to make the payments. Stress testing provides insight into how much those contributions can vary, allowing for sensitivity testing to define what is and is not sustainable, and allows for the measurement of alternatives to mitigate getting to that unsustainable threshold. Your Act 5, for example, is an illustration of addressing finding some of those alternatives to avoid what might otherwise be considered unsustainable. A practical illustration: we all watch the weather, and especially when a storm is coming our way, and we can see that they show us maps of likely trends where the storm will hit. And in this instance, it shows the probabilities of each of those different points in time. Applied to a pension plan, we start with a baseline projection. In this case, we're illustrating a cost projection. And you'd see where, while the numbers are small, the funding cost is 12.2% and gradually going down to 11.4%. So we look at that as a trend and an expectation that costs are gradually going down. That might be a system that adopted a new tier and as new entrants come in and replace older participants, the costs are going down, something that you anticipate with Act 5. But when we take that same projection and instead of applying the assumed rate of return each and every year, we let that rate of return vary within its expected range of volatility because it represents a diversified portfolio, you may come to a very different conclusion in terms of what you should be budgeting for. Instead of a 12%, you might be budgeting for something like a 23% and taking advantage of those years when it's less instead of having to suddenly ramp up because you haven't looked at the risk if things don't turn out as you project. Taking these same results, let's see. Oh, no. See if it'll work. It's not going to work. All right. What this previous slide was supposed to show you is an interactive. No. No, there's a button that would highlight. No, I don't want to go to the next slide. This is an animated slide. Yes. Well, all right, go in there. All right, yeah.
Stop playing it now.
Stop playing it. All right, let's show it in the other version. All right, there we go. I'll animate it.
Yeah, I think,
Okay.
but I don't know how to get it to show on the screen.
Oh, but you can't get it to show on the screen,
Yeah.
and this doesn't do it. That's too bad. That was going to be fun.
Yeah, it looks like a lot of fun. I think they all have this.
Okay.
just wanna
All
direct
right.
them to the
So on
slide
your
11.
on your printed copy, which we protected in the event, to perform a stress test and a stochastic one at that, what happens is the first thing we do is that line that goes across the graph is the deterministic projection, the best estimate. We then run 1,000 trials, allowing future returns to vary within the range of expectation based on a portfolio. And what you then get is a distribution of likely outcomes. That distribution then tells you that, well, we might expect the costs to go up. Do you have the copy?
Yeah.
So I can refer
You can
to
just
it.
hold on to that, actually.
Well, in this one, that we see that the costs are going down, but the distribution, thank you. You're really missing the best part of my presentation because it's not working. So all right. But what you see is a distribution where the costs can vary over time. So for example, in this instance, at the end of the projection, we see that the costs are around 10%. I've got a copy. You can look at your own. Oh, okay. But by 2032, those same costs, there's a 20% chance those costs would be 18% instead of 10. And there's a chance that those costs could be 0. Similarly, there's a 70% chance that those costs could be as high as 31% or 0. And there's a 95% chance that those costs will be under 47% and still 0. The reality is that if you turned around and said, well, our costs are currently 12 and we cannot sustain a cost of 30% or more, then what this tells you is what the probability is that you might hit the 30% and how soon that could happen. With that kind of information, you could turn around and ask the question, what can we do today to avoid that unsustainable event occurring? Without this information, you have no idea what's coming down the road. One of the key things that we find is most important when talking about pension plans and looking at those plans that have recovered well and those plans that seem to stagger at trying to recover, even though, as you heard, the market returns have been pretty good, is the net cash flow of a retirement system. Net cash flow is contributions in less benefit payments and expenses going out. Most mature systems, and both of your systems, have a negative net cash flow. That's common. That's why you're pre-fund, because it's anticipated at some point in time that that will occur. But the magnitude of that negative cash flow can have a direct effect on how well you can recover from an adverse market. So on this first slide, we show a neutral cash flow. Contributions equal benefit payments and expenses, but we showed two scenarios, a 7% return each and every year, and a return that goes down and up, but on average adds up to 7%, and after 10 years, you're at the same place. If we in turn look at a plan that has a negative 4% cash flow, which is not uncommon in mature plans, we see that, in fact, if the markets go down first and then back up, still returning a 7%, you're behind where you would otherwise be. And the reason is because money goes out the door whether you earn money or don't earn money. And if it's not there to recover, then you don't get the earnings back on those dollars. So the effective return here, instead of 7%, is 5.42%. And that's why many systems continue to be surprised and frustrated by, hey, we've had good markets, why isn't our funded ratio improving? And it's a function of negative cash flow. Stress testing incorporates negative cash flow in looking at your projections. The next slide is, to be fair, what if markets go up and then down? Well, you will be ahead of the game, but you won't be as ahead of the game as you might have anticipated after seeing those favorable markets, which is what everybody was feeling in the early 2000s after the 90s rolled through and seemed to demonstrate there was no way to lose. So how do you use stress testing in terms of decision making? Well, and these aren't your numbers, but if your assumption was 7.25% and with a volatility, one standard deviation of plus or minus 14%, this would be a projection of the future funded status, and you'd see where you could be. If you turned around and said, well, that's all great and good, but I'm not sure that we could really live with a funded status in 2026 that would get close to 40%, then you turn around and make decisions. If your first decision is let's reduce the discount rate, but leave the asset allocation alone, well, you've increased your liabilities, you've decreased your funded ratio, but you've maintained the 7%, you've maintained the 14% volatility, and you don't see much of an improvement. If instead you said we're reducing the rate, let's take the opportunity to also reduce our exposure in the markets by reducing our asset allocation to target that rate instead of continuing to target a 7.25%. You can see that now using stress testing, you can demonstrate the implications on the reduction of the risk that the fund is potentially exposed to. And that's just one illustration of how stress testing as part of the decision-making process, not only for asset allocation, but for benefit design, and for any of your other aspects of assumption choosing, can be of value in providing for decision-making process. So without projections, you have no idea if your funding policy works. Baseline projections are never right. Uncertainty increases over time. Most pension plans today are mature and mature plans have negative cash flows. Negative cash flow plans are most vulnerable, and forward-looking potential outcomes are important decision-making factors. Oh, I left that one in. This is illustration of stress testing. If you go on Google and find a couple pictures. And
Very good. Thank you. Thank you, Ken. Next up, Bob Stein, former chair of the Society of Actuaries Blue Ribbon Panel on Public Pension Funding, and from the Society of Actuaries. And I will make mention again that Act 5 brings particular mention of us delving into that and utilizing the work that they have done. Mr. Robert William Stein, former chair of the Society of Actuaries Blue Ribbon Panel, served as global marketing manager and partner for the actuarial services of Ernst & Young. Among other things, he's been a certified public accountant and a fellow of the Society of Actuaries, a member of AICPA, and a member of the American Academy of Actuaries. Bob, thank you very much for being here today. And as I mentioned, we are tasked with coming up and trying to implement some of the recommendations of the Society.
Finding the material. Oh, here it is. We're good.
here you go. Thanks.
Man, it's going to be.
It's playing.
Oh, yeah. I saw that.
TV. Give me 1 second. Let's give that a shot.
You guys are not making actuaries look good over here. This is kind of.
Music there? I didn't put any
No,
music.
there you
Mine are just words. Well, thank you very much. I'm pleased to be here this afternoon for a brief discussion of the Blue Ribbon Panel's recommendations on stress testing and risk management and financial management work more broadly. I know you've had the material in advance. I'll try to be brief and get on to the question and answer part of the program. Just a reminder, perhaps a refresher of who was on the Blue Ribbon panel and what our charge was. I think we had a very strong membership on the panel. We had what I'll call left and right oriented think tank experts on pensions on the panel. We had the former CEO of the PBGC, and we had a number of top actuarial, governmental, and union representatives on the panel. It was a very interesting dialogue over the course of a few years. We started our work in early 2013 and issued our report in early 2014. So we've been encouraging the adoption of stronger financial management practices, including stress testing, for a very long time. And I'm glad to see that the Actuarial Standards Board is now moving in that direction, and that practice seems to be moving in that direction as well. Just a reminder, perhaps, of what the major risks are. To some extent, this is not new news, but perhaps it's interesting in the context of today's conversation, where the vast majority of the discussion has been around the interest rate. I think it's wise to remember that there are a number of other major risks to public pension plans and plans in general. And I've identified some of them here. I think it's clear we would agree, no doubt, that the top two risks are investment performance, and I would put a close second, the ability to consistently make contributions into the plan. I think in both cases, the Pennsylvania plan has had some adverse experience, so I suspect that you know the damage that the manifestation of these risks can do reasonably firsthand. But as some of the discussion alluded to today, some of the intergenerational issues, some of the workforce composition issues, I do think it's good to keep in mind that longevity, that is the lifespan of plan members and the composition of the workforce, how many active versus how many retirees, are also very significant risks, and they become more apparent in recent years, and are areas really where most plans should be completing additional analysis, often of the scenario and stress testing type. In all cases, I would agree with the general consensus here today that scenario and stress testing is really important, and I attribute that to the fact that it can perform three key functions for you, and by you I mean in this case, the trustees and the staff that drives decision-making. First, as Ken and some others have indicated, stress testing and scenario testing can quantify the financial consequences of the occurrence of risk. By that, I mean it can identify the impact of risk on
funded ratios and on contribution levels and dollar amounts, two of the most commonly viewed metrics in the pension plan. Secondly, it can provide a framework for analyzing alternatives for managing the risks, that is, looking at options for reducing risk before they occur. Ken's conversation touched on that at the tail end of his presentation, and that's a critical element. And thirdly, it can aid, that is, stress testing and scenario testing can aid in the development of action plans for responding to and managing the consequences of risks once they occur. So it can be a, how big is the problem? What do I do beforehand to manage those risks, and setting up some actions in advance of risk manifestation so that one is better prepared to deal with the outcome of the manifestation of a risk event. Ken has already defined and illustrated stress testing. I won't repeat that. I'll just focus on the panel's recommendations, which really focus on investment performance and contribution discipline. First, as was alluded to in some of the prior conversation, the panel recommended that one analyze the impact of what I'll call normal volatility about the assumption. In the context of investment results, I think we all know that investment results, be it 7.25 or any other number, do not just come out year by year at the same level. There is volatility about that outcome. So even if we have picked the right long-term average return, that volatility about the assumption generally provides adverse consequences to the financial condition of a plan. And the panel recommends that that so-called normal volatility about the expected result be analyzed and more clearly understood than it is today. Secondly, clearly we focused on stress testing. In this regard, we recommend that 20 years of stress be considered in the analysis. That is 20 years of consistent adverse experience, and that the financial outcomes, the financial results and implications on the plan be projected for 30 years. We say 30 years because we think that will enable a user to analyze the year-by-year impact of the stress on contributions and funded status, see it emerge over time as experience deviates from the assumptions. And I think it's an important element of deciding when to act and when not to act. The levels of stress that we recommend be considered are relatively severe. Investment performance of 3% above and below the expected level of return, again, for 20 years consistently. We selected that because in 10% of the 20-year returns going back a century or so, that was the outcome, that over a 20-year period, results were 3% lower than the mean return during those periods. And secondly, we strongly suggest that contributions be looked at as well, and we recommend that scenario testing, stress testing be performed at the assumption that 80% of the recommended contribution is actually made on time and in full. This is a very simple example of the nature of the output of this exercise. It's a slightly different form than what Ken provided. But it's a simple example of showing the impact of, in this case, the contribution, the effect of the stress event on contributions as a percentage of payroll. It's a sample plan. It's not the Pennsylvania plan. And I would just simply highlight the top line here, not unlike one of the charts that Ken showed, I think, that shows the impact on contributions of a prolonged underperformance in investment results. And I think it begins to hint at how the information can get utilized. And I think that's the key question that you've been asking some of the panelists today and need to focus on. How can stress testing be used to answer critical questions? Can it be used to improve decisions that affect plan finances? I think you're hearing soundly the answer is yes, yes it can. And I would say first and most importantly, in my opinion, scenario and stress testing makes it able for a plan to determine how much risk should be taken. Ken alluded to this in some of his discussions. In the jargon of risk management, it's known as defining your risk appetite. But it allows, once a risk appetite is defined, allows the development of actions to keep the risk within those boundaries. Stress testing might show, this is a slightly different example perhaps verbally than the one Ken provided, but stress testing might show that in half of the future scenarios, the funded ratio will fall below 60%. That, of course, will drive up contributions. The trustees and staff in that situation can then debate whether or not they find that acceptable. Are they okay with that outcome? If they're not, then they can, as Ken indicated also, they can begin to examine options to reduce two things. One, the likelihood that that outcome will occur, and secondly, its order of magnitude if that event does occur. And while asset allocations is a critical element to move to in terms of addressing that potential outcome, different funding assumptions is also part of that, meaning different investment return assumptions. And I would also put on the table different funding methodologies. For example, moving to a level dollar amortization for gain and loss amortization. The Blue Ribbon panel also believes that scenario and stress testing is an essential tool when considering plan changes, and I think I would probably state as strongly as scenario and stress testing is really the best way, maybe the only good way, to get objective evidence of the affordability and sustainability of proposed plan changes, and that analysis should be done, of course, before those plan changes are adopted. I'd like to turn briefly, as I work toward closing, to spend just a few minutes on some of the other risk measures that were recommended by the Blue Ribbon panel. These are not as complex as stress testing, easier to understand, but they can be quite powerful. This first slide is a simple visual history of trailing portfolio returns as they emerge over time, and it's compared to the assumption of this particular plan. This is not the Pennsylvania plan, but it is a real public pension plan. This suggests that well before the financial crisis, the plan was encountering stronger headwinds and perhaps should have acted on the investment assumption well before it did, which was in 2016. I think the Pennsylvania experience, as I've shown there in a simple tabular form, I've just provided the two measurement points, a 10-year trailing return ending last year and the 20-year trailing return ending last year. Obviously, both show fairly sizable underperformance compared to the assumed returns. And I think a history of trailing experience compared to the assumption would help shed light on whether the risks being taken were becoming significant considerable period ago, and whether at some earlier time it might have been warranted to begin to address more seriously the investment return assumption. All that information, though, the trailing information, is obviously backwards looking. This measures, this measurement that I've got here looks forward. It uses forward return estimates using the methods that have been recommended by the Blue Ribbon panel. I think one of the panelists in the earlier session referred to some of the capital markets theory on how to establish these rates, risk-free rates plus spreads, and that's what the Blue Ribbon panel has recommended. Here I've compared the Blue Ribbon panel forward return estimates with the Pennsylvania plan's investment return assumption as I understood it, which I got off the website. I hope I did that right. Looks okay from what I've heard. Again, it shows the forward assumption, which the panel recommends be the basis, the strong basis for establishing the investment return assumption in the funding process. Not everyone has complete confidence in the forward-looking estimation method that we've used here. As was mentioned earlier, it's commonly used in the finance industry. And it's a good indication, one of many, but one indication of the risk being taken in the investment return assumption. And I think it says a lot about the need for all plans to take more timely action on the investment return assumption. Two other quick measures, some of which were actually referred to in the Q&A after the prior panel. The Blue Ribbon panel believes that another strong risk measure can be developed by computing the plan liability and the contribution at the risk-free rate. This was discussed earlier. The difference between these risk-free measures and the plan's calculations using the assumed investment return helps to quantify the reduction in the plan liability and in the contribution that's attributable to earning returns in excess of the risk-free rate. In this sense, it's a measure of the additional costs that would be incurred if the assumed outperformance in the portfolio over treasuries does not occur. The panel believes that this broadly quantifies the magnitude of the risk in the return assumption and illustrates the consequences, i.e. the increase in costs, of not achieving the assumed rate of return over the long term. And finally, the last measure, the Blue Ribbon panel recommends that the plan's contribution be compared to the contribution that it defines as the standard contribution. That's a contribution based on clearly achievable investment results, typically a much lower investment return assumption, and funding methods that are designed to fund benefits over the employee's remaining working lifetime. The investment return assumption is based on our forward-looking return methodology, and unfunded liabilities are amortized over 15 years. And the difference between the plan's recommended contribution and the standardized contribution helps to quantify the magnitude of the additional risk taken not only in the investment assumption, but in the aggregate funding program. In closing, clearly many assessments of the risk to a plan's financial health can be made. We've noted some here today. I clearly think that the scenario and stress testing approach is the best way to accomplish two critical things. One, quantification of risk. I think measuring how bad it can be and expressing that in understandable terms as a measure of the funded ratio and in terms of the change in the contributions as a percentage of payroll is a critical information for all users. And finally, I think it provides really the only objective and disciplined framework for making decisions about how to control and manage the risk being taken by the plan. The Blue Ribbon panel strongly encourages all plans to adopt the scenario stress testing methods and to do some of the supplemental measures that I've just referred to. I thank you very much. I hope that's been helpful and understandable, and look forward to questions.
Extremely helpful, and thank you. So last up, I call him the new kid on the block, Joe Newton, Gabriel Rader Smith Consulting. They were founded in 1938, and they have worked with many plans, including the infamous Detroit Pension Plan. They've done actuarial work for the Texas retirement system. Public pension plan clients include Colorado, Hawaii, Rhode Island, South Carolina, Washington, Wyoming, and Texas. And he will testify today on some practical examples of stress testing. Thank you, Joseph. Thank you for being here today. We appreciate your help to this commission and to Pennsylvania.
Thank you. Thank you very much, and thank you for trying to discredit me before I get started. Appreciate it.
Only just lamenting the fact that when I look at my fellow commissioners and your other testifiers, youth is your advantage, I think.
All right, we'll go with that. We'll go with that. Okay, thank you. Thank you for letting me come speak to you today. I don't work any plans in Pennsylvania, so that could be good or bad, right? So we'll let you guys judge that. But I do work with 9 other states, and for my company, I'm the developer of our stress testing software, so I get to see lots of other states, even that. So I have a pretty broad perspective and experience with these different type of stress tests. And so what I'm hoping to do today is just show you some very practical examples, because what I see a lot with these stress tests, and especially the more extreme the stress test gets, is you go through the process, you create the expense, the actuarial expenses of creating it, you give it to the decision makers, they say thank you, they put it over here on their desk, and then now we move on. And so what I try to do is get very practical with this information in the decision makers, and try to give them something that they can actually use to optimize their situation, because you want to try to optimize the things you can control, because there's lots of stuff you can't control, or there's lots of things that can cause lots of friction to try to control. And so try to optimize what you can control first. And so what I'd like to do here, just look, you've heard the definitions, but I've underlined some pieces. These are definitions you could get off Google or different websites, and I've just underlined some important pieces here. Setting hedging strategies, ensure proper internal controls and procedures, efficient streams of cash flow and payout layouts. Okay, so they're talking about the decision-making part of the process and your procedures. From the Federal Reserve's website here at the bottom, this is what they're saying why they're doing this to the banks, and I've underlined there's 3 main pieces here. Unique risk is the last one. I want to talk about that one first. The Pew Report, one thing I think it's really nice to read through the Pew Report to give yourself a broad perspective, because they looked at 10 different plans. And what jumps off the page to me is how unique the risks are. They're not all in the same situation. They don't all have the same outcomes due to the same stress. And so you can't put yourself in that situation either. I have it all the time. My clients, well, wait a minute. I hear about my peer X, and they're having to do Y, Z, and A. I'm like, well, yes, they need to do that because they're in that situation, and here is why they're doing that. This is why it may not be applicable to you. Works the other way too. Why are we having to do this? Why is it so much harder on us? Well, here's why. Here's exactly what's unique about you. So that's important. And right here on the Federal Reserve's website, they recognize that. The other two pieces are, can you make it through short term, right? Can you make it through the short term? And then what are your policies and procedures to help you come out the other end? And so that's what we're going to look at, and that's the idea there. So the purpose is not to just take the retirement system and blow it up. Okay, that is not useful. Unless your goal is just to close the plan, then yeah, that's probably what you want to do. But that's the whole reason why the membership doesn't want to do this at all, is because they want everything to look great. Like, neither of those are good. So imagine you're an engineer, you're a car company, and you're trying to come up with good ways to do seat belts and airbags. Okay, so you could run the car into the wall at 200 miles an hour and just obliterate the car. Or you could run it into the wall at 10 miles an hour. Neither of those are teaching you anything, right? You're not learning anything about your seat bags, about your seat belts, your airbags, okay? You want to be right there at the point where things are going wrong, right where they're going wrong, and that's where you can learn the most. And then you can start working on the little pieces, go back to the drawing board. Okay, how can we change it so that when, right now at 53 miles an hour everyone lives, and at 55 miles an hour everyone dies? Well, how can we change it so that's 65? Like, what can we do to try to push some of these points out? And so that's what the stress test can help you with. So what can you look at? How is your funding policy going to react? Why do you have your current assumptions? This is one piece of the puzzle. You don't realize how strategic some of your assumption setting can be. And there can be a why, not just a because the actuary said so. Why do we have different assumptions and methods than our peers? How is this going to change over time? A lot of systems might be okay right now, but it's easy to see, 8 years from now, this is not going to work out. Or the opposite. Okay, right now you're having to go through this really bad scenario, but if we can make it through the next 8 years, it really starts to open up some possibilities. What procedures can provide discipline during good times? And this gets back to the benefit talk earlier. Almost all pension plans across the country, you can point to some decision that was made during a good time that is causing problems now. So that's something how can you self-impose discipline? And that can come out of stress tests. That's probably the most important thing that come out of stress tests. And then why do we make those past decisions? I get this all the time. In Hawaii, we've worked for years to get a solution put in place, and the solution is going to work, and it's going to take time, but it's going to work. But the first 2 years after the solution was put in place, they had really good market returns. So all of a sudden, it looked like maybe they didn't have to go so far. Maybe they didn't have to contribution rate, didn't have to go quite so high. And so you get all the talk, well, let's pull back on that. Let's pull back on that. No. Stress test can help you say, no, you made a good decision. You have a 28-year problem. Stop worrying about it and let's move forward. Don't try to gibble at little cookies. Get your hand out of the cookie jar and let's go forward, right? So that's the part there. So what's the typical way of doing it? I was just talking, it was just discussed, a couple of scenarios there. Typically, it's investment returns, and typically, you take your model and you just start putting different investment return scenarios into the model. Okay, so you're choosing the model and you're seeing what the reaction is. And this is just a sample one here we do for clients. It's just funded ratio over time, given, it's just a very deterministic, very simple model. Now, the one thing it does show is what I call the 1% test. And as Mr. Stein just discussed, the 3% test, basically saying, well, what if we underperform by 3%? Or you might use some low standard deviations. Well, one way I look at it is if you can't pass the 1% test, then you can't pass the 3% test. Like if and so I feel like your funding policy better be able to handle a 1% underperformance, because that is gonna happen. Like the 3% underperformance, maybe not. But if you're looking at all periods of decades out into the future, there will be a decade when you underperform by 1%, and your funding policy needs to be able to handle that, or you've already set yourself up for a problem, right? So that's when we do the 1% test and start out with it, and that I've actually got a lot of traction, because if you can show someone, look, if we just miss by 60 basis points, this thing falls apart, that's going to get action. Telling someone if they miss by 300 basis points, there's going to be a problem, well, okay, well, come talk to me when we miss by 300 basis points. Like, no one's going to be willing to stick their neck out for that. My experience is, in general, in the political process, it's very difficult to think, extreme scenarios don't get as much action. It's the real ones. It's the one that, that can happen and will happen. We're not ready. But I want to talk about a little bit different way of looking at it. I try to look at it backwards, okay? Because lots of people, you can come up with these different scenarios. But in general, they're just arbitrary. Okay, we're going to run 1% lower. We're going to run 3% lower. We're going to run 5% over time. We're going to, like, you're just coming up with these things. And based on your bias, you may select one over another one. You know, what if 5.8% return over time is where the line is that it goes from being okay to not being okay? Well, if you want to make the plan look good, you use the 6. And if you want to make the plan look bad, you use 5.5. Like you're able to kind of move that around. And then you might get a stress test that doesn't help you because you're not hitting the line. Again, it's where is the action? I like the other way around. Define a bad outcome. Okay, we're currently putting in 30% of pay. We don't want to put in 34% of pay. Great, there's your line. What scenarios create 34% of pay? And you can get the decision makers I find can relate to that quicker because they can say, okay, how likely is that outcome? What can we do to manage that outcome? But I know we can all agree that's a bad outcome. We're currently 60% funded. We don't want to be below 50%. Okay, well then draw that line. What scenarios push you below 50%? And everyone can agree that's a bad outcome. And so this was just a sample. There's lots of lines here, but this is a client we have where there's a corridor plus or minus 5% of pay that the contribution rate cannot go above the 5% on the top, or there's certain things that start happening. Likewise, it can't go below the 5%. And so we just turn it backwards and say, okay, what returns, what types of scenarios hit the line and at what time period? Are you comfortable with that? Like, for example, the 6.25 out at the end. That's the one I'm most struggling with. You know, the 5% over the next 10 years, you know, it's definitely possible, you know, but that's a couple percent range. We probably can make that. But only having 75 basis points range over the next 30, that one I feel less confident about. Like, that's the one I want to watch, and that's the one we're going to pay attention to. This is another way of just kind of getting to the same idea. This is stochastic modeling, so you're showing the percentages that's been discussed, and so the bars represent 25th to 75th percentiles. So the bottom of the bar is your 25th percentile. You have a 1/4 chance of being below the bar. This is actually a good, I mean, this is probably how you'd like yours to look. You're currently 83% funded. You're moving towards 100% funded. And so you look at there see where the line kind of starts to just hold itself? You know, even in the bad outcomes, you start seeing just holding itself. So it's like, well, what's happening? Well, your funding policy is picking up the difference. The funding policy is kicking in and holding that line. And so I had a board member look at that and said, well, that's great, but I would really like to hold that line above 80. Even though 80% to me is just an arbitrary line. But to him, this was important. What would we have to do to hold the line at 80? I said, well, okay, let's look at that. So, and the answer is you have to shorten your amortization period. You have to make it so that you react faster, a little bit faster, as things are not going your way. Well, that sounds great, but what are you giving up? There's never win. There's always, you're going to have to give up something. And so the shorter your amortization period for a new loss, volatility, that's the thing you're going to have to look at. And so what we did is measure that out and that's what we're showing you here. So the top line is that 25th percentile, the bottom of the bar. Okay, it's where the bottom of the bar sits based on amortization period. The bottom red line is how much annual volatility in your contribution rate you're going to get in general, depending on that amortization period. Plus or minus. Doesn't always go up, right? We've lived in a 20-year period where it only goes up, but it doesn't only go up. Okay, there's going to be up and down. But so you can see at 25 years, which is where they're at 77%, it's where it's held, and they're getting about 66 basis points of volatility. And so to hold that at 81, are they willing to accept 77 basis points of volatility? And so if you think about, like, for typical employers, especially like a city, about half their budgets pay a lot of times, right? So 70 basis points means you're getting about 35 basis points of volatility in your budget annually that you can't predict. Are you okay with that? And so to me, there's your trade-off. There's where you're using stress testing to make that decision. And here I'd like to point out, if you want a suggestion from me to you, the Pennsylvania legislature, you currently have 30-year layered. Okay, so a new gain or loss is 30 years. I'm not talking about the current unfunded liability. I'm talking about a new loss that we don't know about right now. Well, look at this graph right here. Look at this graph as what's happening. Every time you go for 5 more years, the top line is taking another whole step down. There's no diminishing return. There's no slowing down. But every time you go out on the red line, you're getting less. So you're getting less reward for taking that another unit of risk. Less, you see what I'm saying? So to go from 15, it's 104, and you're at 85. So to go to 20, it's 77. So you get about 30 basis points of volatility dampening, and you had to give up 4% on your funded ratio. But to go to 25, you only get another 11 basis points of volatility dampening. You go from 77 to 66, but you have to give up the same 4% in risk. And so I'm just saying, if you're sitting out here at 30, well, look how much, there's really no difference between 25 and 30 in the grand scheme of things, 7 basis points difference in your contribution rate. But you can move that risk closer, and so it doesn't cost you much over time. So that's one thing to think about, is why you're at 30. You're probably at 30 because it was negotiated on the day when you're trying to go through the process, and maybe it costs you a little bit more to go 30, and so people don't gravitate to that. What I'm talking about is a new loss in the future. What are you going to do with that next one? This is something that can help. Okay, so just to go forward, this is the perfect scenario. This is the one you'll see lots of times. Just contribution rate is going to go flat till you get to 100% funded and it drops. Okay, this doesn't exist. We just talked about this. This isn't going to happen. And so what drives me crazy is you see so many decisions on funding policy made in this scenario. This is not the scenario. This isn't going to happen. So I'll just ask you the question. Here's 2 funding policies, both that had the same, we'll call them funding ratio risk or downside risk. Which one would you rather contribute? Would you rather contribute the red line or the blue line? And so what I call a hybrid or a floating policy, basically, this is the discipline. In the future, when the contribution rate could go down, when the actuary in all of his black box says, yeah, we can go down by 30 basis points in contribution rate, don't. If you're 60% funded, come up with a rational reason that a contribution rate should ever go down. Like, if you just think about it that way, you know, the math might say so, but no, hold the line. And so you see the red line just stays up, the blue line goes down, comes back up, goes down, comes back up. You're not having to, because when the blue line goes down, you're going to spend that money, and then it's not there anymore. So when it goes back up, people are going to yell. They're going to forget that they went down. And so this is huge. You can put these type of policies in place and show the client that 75% chance your contribution rates will never go up again. And if you can make it 4 years, if you can get 4 years without having to go up, you're up to 90% chance your contribution rate will never go up again. So we've got Utah working on this, and we've now been able to lower their discount rate twice and not increase contributions. Okay, so this is what I'm talking about, being strategic, looking at this thing, optimizing, because this is not going to cost you benefits. It's not going to cost you much. It's not going to cost you anything next year. It's the next time it can go down, don't let it. Okay, it's simple, but that's what that is. And this actually showed up in the Pew report, so I put this in there because the Pew, I thought, did a nice job with this one. This is, you see on the right here, South Carolina uses this same approach. Look how narrow. Okay, and so, again, it's just don't let it go down. If you don't let it go down, you don't have to come back up, and you will. Okay, we know it's not just going to go straight down. It's going to do some of this. Okay, all right. For time, I'm going to skip that one. Here, I want to talk about benefit provisions real quick. He talked about earlier, the discussion was on the Wisconsin COLA, but I just want to reiterate that. There's nothing that shows positive results in these stress tests like these contingent COLAs. And you can see how much narrower that is. So I'm not talking about gain sharing, some of these old provisions you used to hear about where you just assume zero COLA, you're not funding to a COLA, and if things happen to be great, we'll pay a COLA. Like, that's not what I'm talking about. I'm talking about funding towards a COLA, so your intention is to give it, and you're trying to get there. But if certain contingencies aren't met, that's one place where the liability can begin to release some of that liability and not just shift it all downstream to your new hires, which is kind of the traditional approach. And so I just want to talk in general across all the clients that I've done over time, what's some constructive things you can think about just from stress testing that are probably going to be true. One, this was talked about earlier, if your funding policy doesn't automatically adjust in bad outcomes, it's not going to work. You have to have a funding policy that will adjust to bad outcomes. Two, funding policies that enforce discipline and hold rates up appear to have a profound impact on these outcomes. Three, and this one's a little bit maybe against the grain, but you can get too short on these amortization periods, I think, because you begin to create so much volatility that that's an unsustainable outcome in itself. And what I'll do a lot of times with clients is run, say, 1,000 scenarios. So I run all these generated random scenarios and then go in and actually pick the ones that are really close to my expectation. So if I'm expecting 7, run the 1,000 scenarios and pull the 15 scenarios out that are 695 to 705, that are the actual. So these are the ones meeting the assumption, and show that to the client and say, could you do this? Because what you'll see is it's all this. Can you absorb that? If your amortization period starts getting too short, you could be in a situation where you could meet all assumptions, you could meet everything as expected, but you can't absorb 3% of change in a year in your contribution rate. And so how are you going to balance that? And you say, well, then you go to the other end of the spectrum. No, we showed that too. If you go too far to the other end, you're off the end of the other end. You're not reacting fast enough. So you just have to be careful with that. And it's going to be different across all the different clients. Anyway, and then preventive provisions on the COLA. Anyway, my main point, just as with everyone else, every system has risk. There's no risk scenario out there, so you shouldn't be scared of it. But again, focus on what you can decide upon, not on just a given outcome. So,
Thank you. Outstanding testimony from everybody. Just really important. I do have a question for Bob. Will the Blue Ribbon Panel, will they be able to submit to the commission their recommendations? I know you're retired, Chair.
Well, I was when I ran the panel as well, but the panel technically has been disbanded. I'm not sure if we can get them back together again to make a formal recommendation. I'd have to talk about that offline with you and with the Society of Actuaries.
That'd be great. If we want our consultant to be in contact with you, could you be the point person for that discussion?
Absolutely.
Yeah, and then if we can get information on the report that was developed, that would be important too. So we'll have our consultant,
Okay.
Dr. Monk, reach out to you if that's.
Okay, you have not received a copy of the full report?
That's what we would like. Yeah, that's what we do not have a copy. Okay, great. Yeah. Oh, here's what we like to do. We like to submit the full report to the Joint State Government Commission for circulation as part of the commission's work. So we'll have them reach out to you. In that regard.
Okay.
Thank you. So I think it's so. Your testimony was so compelling because one of the things that I struggle with as chair of the commission is the ability to have the recommendations from the commission implemented, right? So real life scenarios on how to implement these things can be extremely difficult. I know that we've worked for a number of years getting some changes in plan design, and I think many of my colleagues and myself have the battle scars to show for those efforts. One of the things that I notice in the marketplace in our practice is that you have got participants that are suing people in fiduciary capacities of 401k plans. It's not uncommon today. And I kind of always look, when is the day going to occur when defined benefit participants start going back after, or taxpayers start going back after the fiduciaries of defined benefit plans? And you were through some tough times in Detroit. Can you tell me about your perspective on that and using that as a catalyst to implement change?
Well, just to be transparent, I was not personally involved in the Detroit. That's our Southfield office, and what happened there. And so I want to be careful about what I say too much because it's a little hearsay, to me. But
I think just from a broader sense,
I would
the
say
fact
the
that
biggest issue with Detroit was not the pension systems. The biggest issue with Detroit was the sponsor. And if you go from 2 million active population in the city to 600,000, just about any debt of any kind or any future promise you've made to anyone is going to be a problem. And I think that's really the biggest source of the issues. I mean, there were a couple of poor decisions with some pension obligation bonds and things, but really, it's hard to look at that, with situation from just the pension perspective and say, okay, well, that's what caused all this. Well, no, I mean, if the revenue of the plan sponsor drops 2/3 of what it was, there's lots of things you're going to have to deal with, including pension plans at that point. So, and then, and it's all happening at the worst time, right? It's a perfect storm. I mean, it's when the investments aren't doing well. It's when the investment expectations of the future aren't doing well. It's when longevity is increasing. It's when, so your active population is declining, your revenue stream's dropping off, you're missing the liquidity that was just talked about. So, it's the timing was as big of an issue as anything else.
Yeah, I just think from the general perspective that participants in defined benefit pension plans, can look at them, their fiduciaries the same way that people are under private sector 401k plans right now, and the fact that that we have become that society is really important for fiduciaries of these plans to be mindful of things like stress testing and costs associated with the plans. So thank you again very much for your testimony, Vice Chairman.
Thank you very much. Fascinating panel and great testimony from all of you. And I think the chairman's message to those of us who are fiduciaries of the plan is that is the risk, the real risk, that if we don't wrestle with costs and are clear-eyed about risks that we face, and that's an important, sobering reminder. I loved the analogy, by the way, of the crash testing. That there are folks who could use this who may want to drive the car into a wall. Then there are folks who want to use this to show there's no danger at all. But that looking at this is how do we figure out, when the use of an additional seatbelt will save us is a great way of thinking about it. One very easy question for all of you: should a stress test be conducted by an actuary or by an investment consultant? And if you can talk about your reasons.
I'm biased. I'm an actuary by an
I realize
actuary.
this is a panel of actuaries. Yeah.
And a question was asked earlier today. In the actuary evaluation process, you have all the information in order to be able to perform a stress test. Stress test should take into account not only the volatility in investments, but also the implications of the body of assumptions and the potential that any of the other assumptions may not be fully realized in the future. And I believe that it should be included in the actuary evaluation report, which is what is looked at by the public as the actuary certification with regard to not only the actuarial determined contribution, but the soundness of a pension fund. So at least including something in the report that says, here's where we hope things will go based on our assumptions, but here is the potential risk of the results being different into the future, just so that the report is well grounded. Actuarial Standards of Practice 51, which just came out, is going to require actuaries to make statements with regard to the explicit risks of pension funds. That won't necessarily require stress testing yet, but it's a first step in that direction. So that's my answer.
Steve, you have a question?
I
Oh,
would
sorry.
say,
We'll let-
if you're looking for, the mechanics of the process, I think, is probably best done by the actuarial profession, as they've got the tools and techniques, and I think they can integrate the investment results, variability around investment results with the corresponding variability around the contribution levels and other factors that go into the calculation, changing composition of the workforce. So integrating all of the risks into a broad range of stress tests, I think, is something that the actuarial profession is good at doing. But I would say that on the investment assumption side and the variability of potential outcomes going forward, there are few actuaries that, in my experience, have sufficient capital markets knowledge and expertise about what is driving future investment returns, be it in the debt markets or the equity markets, that, tremendous amount of intelligent, thoughtful input from investment professionals are needed. Now, it needs to be challenged and it needs to be examined closely, but I think without getting that kind of input, you'll end up with more arbitrary, let's look at this, let's look at that. And I think you want a more reasoned explanation and discussion around what the range of potential outcomes could be.
Right, and I just want to build on that. I think that's for an annual stress test that you're kind of just seeing where you're at, checkup almost. Yeah, it's probably just the actuary at that point. But yeah, one thing we've been working with, and next year's gonna be the first time we brought it all together. We're gonna do the asset liability study, the asset allocation study, experience study, all that together in one study. And I think, and once you start thinking about it that way, it's like, oh, that's the only way it should be done.
Mm-hmm.
Like, to me, why should we have different answers and different results? I agree with Mr. Stein's point that the actuaries probably, we can come up with some scenarios, but I feel like a lot of our techniques are they create too arbitrary of outcomes, a little too random of outcomes. just putting Monte Carlo scenario with log normal and stuff like that. I think it just gives you too wide of a distribution of outcomes. And so a lot of times I'll try to get from the investment consultant, okay, give me 1,000 scenarios to run through my model, because I feel like they do a lot better job of capturing some of those nuances and patterns in the world. But, you know, of course, all you're doing now is just adding costs, right? I mean, all you're doing is just stacking up if you're going to do it every year. So I'm not sure you have to do that advanced of a project every year. And I'm not sure how much, if you go through all that last year, how much additional information you can get next year. So I think you kind of have to split that up. But I would say, hey, if you have all these big projects across these different groups. Look, you have one organization, one strategic objective, or very few strategic objectives. Shouldn't they all be working together to come up with the best possible situation? So.
Thank you.
Steve, Mr. Nichols?
Yes. Thank you. I appreciate your comment, Mr. Newton, about stress testing, and it's always possible to find an extreme set of scenarios to blow up the system. I kind of react like that when people start talking about applying a 3.5% risk-free discount rate. And I would love to have them go talk to the governor's budget office and the leaders of the Republican House and Senate, and the Democrats as well, with regard to what that would cost the employer if that were put into effect. And I keep hearing this risk-free scenario. It's just so pie in the sky to me when you have pension funds that are between 50 and 60% funded. And I'm just, can you deter me in those feelings, any of you? As to why, I mean, what useful information does that provide when you can't realistically fund at that level?
I think that's the question. What information can it provide? I don't think anybody, including the Brewer-Emmett panel, is suggesting that the funded calculations use a risk-free rate, but it's presented purely as a measure of risk. How much risk are you taking over and above the risk-free rate in the equity allocation and the debt allocation, let's say, to keep it simple, and what are those spreads? And then you can measure the impact of not achieving that. So it's simply, I think the panel would present the view that it's simply a measure of the risk in your underlying assumptions. So, you know, there's a lot of, as was discussed in the earlier panel, financial theory for measuring the liability at the risk-free rate because it's a risk-free payout. But from a plan management standpoint, the panel would recommend, the Blue Ribbon panel would recommend that it simply be used as a risk measure. We did not recommend that funding calculations be done at that level. We recognize, I think everybody does, it would be unreasonable and unrealistic. And if you did that relatively soon, you're likely to materially overfund the plan and create other problems. So we have used this forward-looking methodology that's based on the risk-free return plus reasonable and I'll say highly achievable spreads in the equity returns and the debt market returns and the credit spreads. So we're not suggesting, I don't think anybody is really suggesting funding at those levels, but using that as a tool to measure how much risk you're taking, I think is a legitimate exercise, which has now been, I think, incorporated in the actuarial standards board requirements.
I guess what concerns me, you know, working for a union, is that those numbers are then often used against defined benefit pension plans, period. And they don't seem to serve a useful purpose except for kind of the enemies of those plans to try to convince everybody to go to 401k type accounts.
I don't disagree. We had, maybe you know Mike Mazurak from the New York system, New York employee union. He was on our panel, and Mike was a forceful proponent of the thinking that you've just described, that it begins to be misused and used as a cudgel in the negotiations with union representatives. And I think that is a danger. One has to recognize that, you know, there's a lot of different measures, and they don't all point to the right way to fund the program. So, you know, evaluating risk versus funding, I think, has to be separated. Maybe it's a nuance in many cases, but it's an important distinction. And I'm not aware, I've not read or seen anybody that's actually recommending funding at that level.
With regard to the part of Act 5 that creates this commission, I've always been kind of bemused by the fact that we're instructed to implement the recommendations of your panel. My understanding is what your panel did was make recommendations. There's currently a comment. Your panel's now disbanded. There's currently a comment period which ends tomorrow, I believe, and it will actually be up to the board itself, or I don't know, pension committee of the board, I don't know which, to adopt the final recommendations or the final ASOPs, actuarial standards of practice, which could be different than what your panel was actually recommended.
That's generally true, sir. A couple of distinctions. One, the panel that I chaired was a creation, I'll say, of the Society of Actuaries to bring together a dozen or 15 experts in this area to try to evaluate solutions or proposed solutions to the pension funding problem. We were not connected to the Actuarial Standards Board in any way whatsoever. The Actuarial Standards Board operates separately and independently. They have adopted and put into effect, and these gentlemen are probably more knowledgeable than I, but ASB 51, which is the requirement that stress testing be performed, doesn't really define much about how to do that. The other three, I guess, ASBs that are being evaluated now relate to disclosures fundamentally and recommendations on how to set the discount rate and how to set other economic assumptions and also non-economic assumptions. And there you're right, the comment period does end tomorrow, but they're really dealing with a variety of issues, some which the panel raised around setting the discount rate, and they may well come up with different recommendations. They've actually left it a little bit looser than the Blue Ribbon panel would recommend in terms of using this forward rate methodology and setting the investment rate. So I think they will end up in a softer position, in my opinion, than where the panel was. With respect to stress testing, I think we're pretty much on the same page. We're both recommending that it be done. I think there is a big issue facing the profession around how to provide some, I'll say, guidelines around achieving some degree of consistency around performing stress testing. I mean, it's a little bit like the conversation I listened to this morning around cost evaluations. Do you want every plan doing their own evaluation and using different metrics and different tools and so on? Or do you want to try to move towards some consistent methodology to understand cost levels? Somewhat the same issue here, a little trickier because I think, as Joe said, each panel or each plan is very different and their level of stresses that you want to examine is somewhat different. But nonetheless, I think there is a need for additional guidance from the actuarial profession or as practice emerges to narrow the range of practice. One thing that I have witnessed in the pension practice, and these gentlemen may have a reaction to it, is that when there's a permitted variation from a midstream practice for various reasons, practice in reality becomes like this. And I'm a very strong proponent for providing guidelines that keeps the range of practice like that, so that you do have some rational understanding of what's being done and that you have a little better ability to compare conditions in one plan to the next. In your search for solutions and alternative reactions. So long answer, but there's a variety of players at work here. We made recommendations. Some have been adopted by ASB 51. I think there still needs to be work done there to narrow the range of likely practice in the near term. And the other most important matter, setting the discount rate assumption, I think in my personal opinion, I think the Actuarial Standards Board is still leaving it a little bit too wide open in terms of a range of potential results that you could achieve. I'm sorry for the long answer.
There will be differences of opinion amongst actuaries about that.
Oh, yeah, no question.
Especially the proposed.
Yeah, I have no life, and over the weekend I actually look at the comments that have been filed to date, and it appears that the area that appears to be a greatest disagreement was ASOP number 4, and particularly the investment risk defeasance measure, and why that would ever, coming up with the solvency cost of disbanding a pension plan when you have constitutionally protected benefits, why you would even want a public fund to come up with that measure, and what purpose would it serve? And I'd be curious, I mean, that's the,
Yeah, the defeasance
my
measure-
interpretation of what I was reading in a number of the comments.
Yeah, that, I mean, that recommendation in the ASB was consistent with the recommendation that I talked about earlier, measuring the liability and the contribution at the risk-free rate. Fundamentally the same calculation, slightly different nuance based on the way the ASB defines how to set the discount rate there. But the panel, I mean, I can't tell you what these gentlemen may be able to tell you what's in the ASB Pension Committee's mind when they're looking for making that recommendation. My belief is that it's a reasonable measure of the risk being taken on the plan's asset allocation and its ability to sustain the differential between the risk-free rate and the assumption that they've got in the funding calculation. You know, today, if you look at a 30-year, 20-year, they're about the same. Treasury, it's around 3%. You're at 7.25. I think understanding the magnitude of the impact on the liability and the annual hurt that you'll experience if you don't get 7.5 or 7.25 and you get 3, which is where the risk-free rate is today, that's useful information to me. And I can then evaluate whether would I be more comfortable, you know, moving down to a lower discount rate and beginning to narrow the amount of the contribution at risk, if you will. So I view it as an element of the stress testing, an element of the risk measurement process, and simply one data point that tells me something about the magnitude of the risk in the program. I think most observers would look at that and say, well, you know, 3 is, you know, I understand the treasuries, I understand 7.25, I don't know how they got there, but that's a whale of a big risk margin. When you're at stock market highs and interest rate lows, you're not going to get the debt returns going forward. They're only going to go down as interest rates rise, right? The returns are, you know, the total return is going to go down. And we're at all-time highs on the equity market. It's only going to go down too, in my opinion. So I think it helps to understand what the magnitude of the impact is on the pension plan. That's all, not a funding calculation.
But you do acknowledge a public plan that's with constitutionally protected benefits, that it's
Right, the word defeasance rate may be a poor use of defining the measurement. But I agree with Bob. The difference between that measurement, whether it be treasury rates or whether it be the entity's ability to float taxable bonds as a more appropriate way of saying how could we defease this unfunded if we went to an open market. The difference between that and your assumption does define how much of the liability you are anticipating through your processes will be covered by additional investment return over a risk-free rate. And it will also help define, when you reduce your discount rate, how much risk you're removing, taking off the table, with the opportunity that if that amount of risk is still significant, then motivating you to look at additional opportunities in the future to continue to reduce the risks of the system, which benefits all sides.
I guess I just fall back on you know, an extreme measure like that. You know, sitting on a pension board and having been a legislator, some of the stochastic modeling makes a heck of a lot more sense to me in terms of convincing me as a policymaker or a pension board member, as opposed to an extreme scenario of that nature.
Absolutely.
That's unrealistic, can't even be done legally.
Thank you, Mr. Nichols, for your comments, and I think we understand that the actuarial perspective is data is very important, and those more data points are very important for some assessment of the situation. John, you have a question for the panel?
Just one quick question for Mr. Newton. When you were going through your various scenarios, et cetera, did I misunderstand you? You said the best way to keep our systems solvent over the long period of time is a consistent what's the word I'm trying to use? Not investment, but consistent contribution by both the members and the state. And if we don't deviate to that. And by the way, you said in the very beginning that most of these pension funds that have problems are because of euphoria, okay? And we can talk about what took place in Pennsylvania in the late 90s, which I'm sure you're already aware of. And that's why we are where we are. Thank you.
So that draws our hearing to a conclusion. I thank our testifiers once again, very much appreciated. And as I mentioned to the other testifiers, we would appreciate if our consultant or the logistical people on this effort are in touch with you, that you further give us some consultation. It is very valuable to us. I want to thank my fellow commissioners. I want to thank everybody in the audience. I want to thank the House of Representatives for hosting this meeting today, and the Joint State Government Commission for their coordination and effort. Our next meeting is scheduled for August 16th. We are tentatively scheduled, but we'll get more information in that regard. And again, if we want to submit ideas on further testifiers for the upcoming 2 hearings, if we can please do that within the next 2-week period, we will move ahead. So thank you again, everyone. Enjoy what's left of your day. Thanks.
Thank you.